Hi everyone, this is Andy in Business Development at Mortgage Heroes, and this is Monday Mortgage Minute. Well, welcome to Monday Mortgage Minute. As you can see, I'm not at the office today. I'm at my new dining room office, and this is where we will be for the next several weeks. Today, I wanted to make an extended Monday Mortgage Minute to talk specifically about the Fed's new announcement of how they're going to be helping out specific industries. Now, the specific industry is actually kind of a broader term in the sense that they're bringing more financial stimulus than they had already committed to do. Now, last week we were talking about how they brought $700 billion to the table. $500 billion was going to be for treasuries, $200 billion was going to be for mortgage-backed securities. And today they just unveiled, they're like lifting off the lid on that, and they're gonna do whatever they have to get back to a sense of normalcy. Now, that puts us in a little bit of a quandary because there is no limit, but also we have to at some point trust that they'll use a measured response in order to get this thing going again. So this literally does not mean just free-for-all spending everywhere. That'll just put us in even more debt than we are now. But it also has to happen to some degree, like we've been talking about, because we have to get people to work. We have to be able to pay rents and pay mortgages and get consumer spending going again. We have to have businesses that are open. Now, one of the things that even happened in today's announcement is for the first time ever, the Fed announced that they're actually going to be investing in commercial mortgage-backed securities, which to my knowledge hasn't ever happened before, and I think this is the first time it's been done. And I think that is kind of a nod to the fact that they understand that the commercial business is going to be heavily hit, with so many businesses that rely on person-to-person interaction still that can't go to work and can't have customers come, and customers are being told to stay home, workers are sent home, but a lot of workers that are sent home can't work from home. So I think that this is an admission of the size, quantitatively, of the size of the problem, but also that they're gonna have some sort of stimulus to help and support. That's really good news. The bond market reacted really favorably this morning to the announcement that there's gonna be even more help coming, and you're gonna see rates go down. We had been saying that weeks ago when they initially came down and they went away. I saw a meme the other day, it was really funny. They were like, low mortgage rates was like toilet paper. 2 weeks we had a lot of them, and now we have none of them. So you're gonna see rates come back. Already on today's rate sheet, you see pricing improve, and what we're seeing happen and what I think is gonna occur is that this is going to give some sort of confidence to the marketplace that the government is willing to do whatever they can to keep liquidity and the flow of money going. On my personal Facebook page this weekend, I was talking about the lesser of two evils, being proactive or reactive in a market that's in a deep slide like this. And being proactive costs a lot of money, and being reactive also costs a lot of money, but because the problems get bigger and bigger over time, it ultimately costs way more to make a response plan in reaction to something than it is to be proactive. So whether or not this is a popular or unpopular move, ultimately isn't up to us to decide, but we are going to have to participate if we're going to take advantage of it and help people. So those of you who have been in line and you've been doing your refinance and you've been halted because the prices went against you, those are gonna come back. It's already happening a little bit today. You need to be on the edge of your seat waiting for us to lock with you. And when we say it's time to lock, it is time to lock. And if you are working with some other company, but you're watching this video and your loan officer calls you, and the rate that they're giving you is 0.5% or more, less than what you have now, you need to lock that bad boy when it is at your doorstep. Do not wait for yet another price drop. Once you have a price drop, don't expect it to just drop even further again. There is a limit to how much prices can go down. We talked about this before, that if you have $100 million to invest, and the investor said, I'll give you 0.5% on your money, you'd be like, no, I'm not gonna do that. That doesn't help me. So there is a limit to how far rates can go down, because the people who are investing in mortgage-backed securities, they need a return on their money. So we're not gonna see 0% 30-year fixed. You're not gonna see a 1% 30-year fixed. That's not the case. At best, you'll see something in the high 2s. If you are at 3 or just above 3, I'm telling you that is gonna be a real sweet spot for the weeks and months to come. And as new information comes out, we'll keep you informed, of course. And If you have questions, as always, you can write them here in the comments, you can DM me, and I'll be happy to answer. There's a lot of other economic stuff that we're gonna talk about over the course of the week that I'm talking about personally on my page that has to do with the general marketplace, the marketplace in general, but specifically mortgages. Those of you who have been waiting to take the right action and get a lower rate, that's gonna be coming up. If it's not this week, it's gonna be next week, but get ready. Those of you who we've been telling to be organized, who we've been telling to be patient and to be ready to react, this is exactly what I was talking about. So those of you that heeded that warning and got yourself prepared, this is your moment. Thanks for watching Monday Mortgage Minute. We'll talk to you again soon.